Hey everybody, good morning. Marty Mazzara, the 8th of May 2019. Haven't done a video for a few days, so I thought I'd just jump in and spend a couple of minutes, maybe 3 or 4 minutes on the chart. I'll try to keep it quick. This is that daily S&P 500 one-year chart that we've been looking at for several months now. Notice that I drew some trend lines up in here. Technicians would call that an upward sloping wedge pattern. More often than not, it breaks below that particular pattern. Notice we had it up here in September and October when we broke below, and we had it developing here as well. Similar look here, isn't it? You can see how we found support right here about 28.63, 28.65. That's exactly where we found support yesterday. Although here it had breached the 50-day moving average at the same time, battled with that a little bit before giving it up entirely. Here we haven't yet tested the 50-day moving average. That could end up being pretty important support. And then it's the 200-day moving average. I think this 2800, if we get there, is going to be exceedingly important. As you can see, there was a lot of activity right on that line. Disappointing buyers in here become disappointed sellers as we break through it here. 2800 would give disappointed sellers a chance to become buyers if indeed they're so inclined. But make no mistake, there's going to be some action right here at 2800 if, and that's an if, we get there. So you all know what's been going on, of course, if you've been reading my blog, but of course you don't need to read my blog to know what's been going on. We've had quite the whipsaws in trade news the last few days. There still seems to be the strong desire to say we have a deal as early as this Friday. China seems a little less conciliatory to me right now, so we'll see how that plays out. I've been pointing to a number of indicators in a blog over the weekend. I showed you a little bit of our in-depth weekly analysis that said the cyclical sectors are doing less well than the defensive sectors. That's not a good sign on a near-term basis. I've talked about a lot of complacency, a little too much optimism in certain circles, too much in terms of one-sided bets that volatility is going to go down, and really nothing in terms of short bets that the S&P is going to fall apart. So just a little too much comfort. I've been calling it complacency. And that suggests, as I said, right up here when the market was right here, that if we rock the boat a little bit with all that complacency, as those people wake up, you could see an exaggerated move to the downside. Yesterday felt big, but really in the grander scheme of things, it really isn't. If you look at this big rally we've had, normally you retrace 35 to 50% of that. That's going to take us somewhere down in here. And that's just under normal circumstances. I think that if we don't get something that will bring optimism into the trading community here in the next couple of days, I don't know that this 50-day moving average is going to provide much support. I do think 2800 will. Those of you who have brought in new cash, I think you know why I've been so stubborn under the circumstances and under all the rhetoric around trade. I'm looking for some short-term clarity that it's a good time to enter the market. For myself and all of our clients who are already invested, this is not the kind of situation where general conditions in the economy are rolling over, and therefore we have to act to try to mitigate, as much of the next bear market as we can. That's just not what our analysis says. Our analysis says the market on a very short-term basis, it looks very precarious. On a longer-term basis, conditions still look bullish to us. As I've reiterated again and again and again, the one thing that can bring this expansion and this bull market that we've enjoyed for so long to an end sooner than conditions would otherwise dictate would be a big protracted global trade war. And that's really the existential risk to the market right now. Anyway, to close, let me show you our volume indicator that we paid so much attention to. You can see on balance volume, as you might imagine, has broken down below this bullish trend line here. So now we have a lower high, so that's consistent with the sell-off here. A look at momentum using the moving average convergence divergence or the MACD. You can see we had our bearish divergence just like we had here. We had our sell signal here, very consistent with that as well. I was showing you this before this rolled over is one of the reasons why I'm somewhat concerned on a short-term basis, plus the other things that I've been blogging about of late. We'll keep you posted on the developments and our thoughts on those developments. It's going to be a very interesting rest of the week. Talk to you again very soon. Take care.